Hey guys, welcome back to the channel. Today's video, we're going to be looking at the S&P 500. Now, most of you know, if you followed my videos, the ETF for the S&P 500 or the VOO through Vanguard has always been one of my absolute top picks. Now, looking at Berkshire Hathaway, the annual meeting that they've had, billionaire and legendary investor Warren Buffett has said, in my view, for most people, a big majority would be an S&P 500 fund. Now, we've also covered a few articles where over 80% of financial advisors, that is right, guys, there are only 20% of financial advisors who have been able to beat the S&P 500. So that is the reason why, again, the great like Warren Buffett talks about that. Now, in a sentiment, he stood up, he repeated himself and said, it has helped to mitigate risk. If you're looking at choosing individual stocks, it can be very, very tricky to not only pick the right company, but to pick the right company at the right time and also have the funds to do that. That is why the reason, not only with the S&P 500 funds, it has a very low cost of entry, very low fees, even with a lot of the automated services like M1 that you can buy for zero commission fees. You can get in there with literally as low as, I believe it is $50 to start the account. It might be $100 to start the account. But overall, the S&P 500 is a market index that tracks the performance of the 500 largest companies in the United States, which is the reason why I invest in it. When you look at some of the biggest holdings, Amazon, Google, looking at Alphabet, Meta, Visa, even looking at Tesla, looking at Apple, looking at the largest companies that the S&P 500 hold. Now with that, guys, it covers all different sectors. It covers an incredible amount, again, 500 companies, and they do alternate the companies based on the size. So if there are newer companies that are making groundbreaking, really strides that join the S&P 500, this is a fund that is actually adjusted as companies enter and fall off in that S&P 500. While the index is not immune to overall market downturns, long-term investors have historically earned near a 10% average return. That is right, guys, an average of a 10% return in the S&P 500. However, with all investments, it's important to note the past performance. And this is something we're looking at today, guys. So when you think of $1,000, literally putting $1,000 into that VOO, the S&P 500 fund, what would you have today if it was last year? So looking at last year, if you invested that in 2022, you would be down to $942. That is right, guys. Your $1,000 investment in the S&P 500 worth today would be $942. So you lost a little bit, but that's okay, guys, because when you start stretching it out and looking further, so if we go back 5 years, that same $1,000 investment, if you dropped it in the S&P 500 5 years ago, would now be worth $1,689. That is right, guys. You have a extra $689 over 5 years. Not a huge return, but then we go back 10 years ago, and this again is really the compounding factor of interest, the compounding factor of market growth. So if you invested $1,000 in 2013, you would have $3,217. That is right, guys. Your $1,000 would have doubled when it hit 2,000. It would have went up another 1,000, hitting 3,000. So over the course of 10 years, you would have 3 extra money, getting $3,217 on a $1,000 investment. Now, with the law of numbers, and what I really think, guys, is if you're only talking about $1,000, what if that was $10,000? Then you get your extra amount. What if it was $100,000? You can see how exponentially this is going to get. Then you add, even more than 10 years. Let's say you go to 15, you go to 20, you go to 30, 40 years. Guys, the numbers just exponentially get larger as you continue to go through and kind of going through that path. And this is the reason why when you look at Berkshire Hathaway, when you look at, Warren Buffett, when you look at some of the great investors, guys, it is not only the stocks that they have picked through time, but it is also the consistency of investing that we've talked about a lot on this channel, is automating the investing, making sure that you're putting X amount of dollars, whether your portfolio or whether your investment is 15% of your salary, if it is, $100 a month, depending what you're putting it into, making sure that you are consistently and constantly putting money into an investment. S&P 500, again, is my really, really big choice. So why do I choose index funds? One of the big reasons, guys, is because with the S&P 500, it is an ETF that gives you access to, of course, the 500 stocks, which mitigates the risk. if I put my $1,000 into Apple and Apple just drops, let's say 50%, the chances of that happening to an ETF fund or to one specifically like this is almost zero, guys. How absolutely detrimental this portfolio would be hurt if 500 companies in the United States dropped by 50%, which again is the reason why I always choose the ETF funds versus individual stocks. I actually don't hold any individual stocks, guys. I do hold a couple of ETFs, which I absolutely love. Now, another big thing with ETFs, guys, is they are cheap. So a lot of places, if you have a financial advisor, normally they charge a 1% fee right off the top, combined with possibly monthly fees, possibly trade fees, possibly a couple other things, where again, looking at the ETF funds, they are super, super cheap to get into. Now, we've talked about the compounding before. When it comes to investing, the sooner you start, the better, guys. It is the compounding interest. So here is how it really works. And I wanted to break this down in this video. After you make your initial investment, you theoretically earn a return on that principal amount as interest added to your balance, which again is kind of the compounding. You begin to earn interest on that amount as well. So again, if you have $1,000, let's say a 4% return, at the end of the first year, you have your $1,000 plus the $40, which is the return that you get in there. In 2 years, if you earned another 4% on the entire total, you would not just have the principal of your $1,000. End of the year, you would have $1,081.60, because not only did you get another 4% on the initial $1,000 that you had, but on the $40 it made, you made another $1.60 in year 3. Then you'd earn 4% on that year, so on and so forth going on. That is the reason, again, the absolute magical effects of compound interest. And that is if you just put the money in there. Now, if you put, again, $100, let's say every single month, $1,200 at the end of the first year, you get that compounding interest start going. At the end of the second year, you have your $1,200 original, you have the $1,200 of the following year. Now you're up to $2,400. The compounding effect just literally snowballs into a much larger, faster snowball. The more that you put in there, guys, the more it is going to compound, which again is absolute craziness to think. When you roll that out, even looking at compound interest calculators, things of that nature, you can see when you get 5, 10, 15, even 20 years out, if you're putting, let's say, $1,200 a year over the course of 20 years, the compounding effects of that, and that is only on 4%. Now imagine the growth factor if you're getting to 10% of an S&P 500 fund would be absolutely phenomenal to see the growth over a 20-year period with making regular contributions into that investment account. All right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.